Good afternoon. Let's do some business. We are doing it live and doing more at 4 weekday afternoons. We get right down to business here with the news-driven hour right after Ben Shapiro, and we do this just before the 790 KBC News Blitz with Randy Wang at 5. Mottek On Money, live on the air on 790 KBC, streaming live online worldwide at kbc.com, and your on-demand Mottek On Money podcast, kbc.com, Apple, iTunes, and all your favorite podcast platforms. Feeling hot, hot, hot today here in Southern California. Stocks, though, not so hot, closing mostly lower today with the S&P 500 and NASDAQ ending down for the fourth time in the past 5 trading sessions. Investors continue to focus on the prospects of an economic slowdown based on the latest cards that have been laid on the table. We'll be getting the big enchilada, the monthly economic reports this Friday. That's the monthly jobs report from the Labor Department. The Dow coming in for a closing gain today of 38 points. The S&P 500 down by just about 9 points, and the NASDAQ down 52 points. Looks like the S&P 500 was pressured by a more than 22% drop in shares of Dollar Tree. The discount retail shares suffering its biggest daily sell-off in 23 years today after Dollar Tree reported second quarter earnings that fell well short of analysts' expectations, and they cut their full-year outlook. Of course, all this a day after the major averages had their biggest percentage drop since that washout we saw last month on August 5th. Rough start to the new week and the new month of September, coming off the 3-day Labor Day holiday weekend. Stocks getting hit yesterday on a disappointing reading on manufacturing. Investors moving to the safety of government debt today amid lingering concerns about an economic slowdown. The yield in the 10-year note is back down to 3.77%. That's the lowest we've seen this year, the lowest since July of last year. U.S. Steel back in the spotlight. Don't often quote U.S. Steel. X is the symbol on that one. As most people know, the stock is down more than 17% today on reports that President Biden plans to prevent the company from merging with Japan's Nippon Steel due to national security concerns. The Washington Post initially reported that President Biden plans to block U.S. Steel's nearly $15 billion merger with Nippon Steel of Japan. This in the face of bipartisan opposition that favors the company remaining under the control of a U.S.-based entity. The Magnificent One, NVIDIA, shares sliding again today, down nearly $2 to 106 and change. And C3 AI seeing revenue growth accelerate in the latest quarter, but that stock down in extended trading this afternoon. It looks like C3 AI shares down about 17%. This is the company that makes software for enterprise AI, seeing a net loss that came in worse than expected. Coming up later this hour, I'll talk AI, IT, and cutting-edge technology with Dr. Nicole Turner-Lee, Senior Director of the Center for Technology Innovation at the Brookings Institution, founder of AI Equity Labs, and author of the book Digitally Invisible, How the Internet is Creating the New Underclass. She's just delivered the closing keynote conversation with yours truly at the HMG Strategy Southern California CIO Executive Leadership Summit in partnership with Southern California SIM, and we thank the conference chair, Thomas Phelps, for making that possible today. Also later this hour, I'll talk about the real cost of driving involving long distances these days. It's not just the price of gas, but your annual mileage, which plays even a bigger role in how much you spend on gas. We'll talk about that with Alex Gailey, who writes about consumer finance and economic trends at Bankrate.com. But first, on your money, the markets, the economy, and the whole works now. Joining us live is Jim Hausberg, market analyst with Hightower Advisors, the Hausberg Group in Beverly Hills. Jim Hausberg, thank you very much for coming to the line this afternoon.
My pleasure, Frank, to be with you and all your listeners.
Great to have you with us. Wild week. Yep.
Just 2 days in, and, September was a pretty bad day, one day. But we got a long way to go, Frank, as we know. And people get caught up in one day thinking something's going on. Look, everything that I'm reading and seeing and talking to different folks is the focus really, Frank, is on interest rates and how low are they going to go. And is it the economic data that's weakening? Is that why rates are going to go lower and the Fed's going to lower more? Or is it because inflation has come down from that 9% reading several years ago back to the 3 range? And, of course, they're also looking, as the Fed needs to, at the unemployment rate, which has edged up. We've also had a couple of earnings from Dollar Tree and Dollar General. Those lower-end retail stores came in weaker. Stocks have been hit hard. So there's a concern out there that, the lower earners and the places they shop are having issues more than the upper-end stuff. But time will tell. It's been a great market. It's been a great year again for both stocks and bonds. You look at the NASDAQ where people are concerned with the 3% drop. Just a reminder, even though looking back doesn't really tell us where we're going, 43% return in the NASDAQ in 23, up 15 to 18, year to date. Those are big returns. I don't see that continuing. The companies are doing great, the Magnificent Seven, but maybe the returns are going to come from other parts of the market. And I think that's why we're seeing profit taking in a bunch of those, especially NVIDIA, which was up, it's down in 150% in 9 months and 10x over the last 2 or 3 years.
Let's talk about the Magnificent One, as it's known, NVIDIA down again today. What do you see ahead for that one?
I think it's in for a tough road in the marketplace, Frank. The numbers are so good, you have to wonder, can it continue? And the stock is not cheap, but it's not really expensive based on the earnings growth. I'd buy the stock on weakness, and I'd be a long-term holder. But over the near term, the volatility is going to continue. You're talking about I don't have the numbers, whatever, 80 billion, or I could be off by several, but the numbers have been incredible. 75% profit margins is unheard of, and the demand is through the roof by all these other companies like Meta, Amazon, Microsoft, and probably Apple one of these days, spending just billions and billions of dollars on CapEx, which plays right into the hands of NVIDIA, which is the leader in that space.
All right, let's talk about the other story you mentioned here about Dollar Tree taking a big hit today. Dollar General also having issues, and I passed by several 99-cent only stores that have been closed. Of course, they went out of business this year. What's going on with the lower-end retailers?
Yeah, I mean, the numbers – listen, remember one thing about these stocks. Dollar General and Dollar Tree make money. They just didn't hit their earnings estimates, and they're off by a lot. But still very profitable companies that are cheap on a PE basis, price to book ratio, and still earning $5 or $6 a share, $5 to $6 a share for Dollar Tree. So the stocks get hit. What happens today, Frank, is when you miss your earnings report, the market punishes you right away. And in the past, it would take 6 or 9 months for it to drift down 20, 25%. Now it does it in an hour. So that's how fast markets move today. It's already discounting, the next several quarters of weak earnings. But these companies aren't going away. Their customers aren't going away. Maybe they're spending a little bit less than they have in the past, and that's why there's some weakness in those stocks. But I wouldn't sell those stocks down here. I'd probably hold on. I just don't see us going into a recession, which would probably impact markets all over the place. But I do see several rate cuts, which in the past has always been positive for stocks. The economic numbers have been strong. GDP was revised up. Retail sales, although not everywhere, obviously, were higher. But, we're keeping an eye on that unemployment rate, which has edged up a bit more than some people are comfortable with.
Right, and we'll be getting a new reading on that on Friday. We're on the air live with Jim Hausberg with Hightower Advisors and the Hausberg Group in Beverly Hills. And yeah, it's this year's flying by here, Jim. We got September here now already. I saw the Halloween stuff up, by the way, already about a month ago. And before you know it, Thanksgiving and the holiday season. Where would you be placing your bet among the retailers with the low end under pressure here? Is it the high end that's in favor, or anything that gets your attention there?
Well, the retailer to own is probably Amazon, Frank, even though it's obviously online shopping versus the retail stores that we know. I think the high-end stuff is going to do better than, say, the lower end. But it's just not an area that I would really focus on. I think the next several months, there's so much uncertainty, Frank, over the election and the outcomes. And, if Trump wins versus Harris and what things may change tax-wise and policy-wise. And I think one of the things with the employment rate is I think if you're a company looking to hire, I think you're kind of waiting to see what the next 2 months bring. I think a lot of things are somewhat on hold just as a result of the election coming up and the uncertainty, because it's going to be very close. And what happens in the House and what happens in the Senate could also impact policy. So I just think the market's a little bit on hold. As I said before, the numbers were fantastic last year. They've been strong this year. If stocks historically do that 9 to 10, Frank, that we've talked about over time, and you're seeing 15 and 24 in the S&P last year, it just, you got to know that markets are not going to keep going at that same pace. But I do think we've got the tailwinds with the lower rates, and I think that's what's going to drive markets. But I can't really pick a retailer per se, except Amazon looks like the big winner to me.
All right, certainly a lot of wild cards on the table as we head toward Election Day, and a lot of geopolitical concerns. The volatility index had that big spike yesterday. It was up again today. Would you be betting on volatility at this point?
Yeah, I think volatility is going to continue. We got the jobs number that comes out Friday. I will say this about all this economic data, Frank. There's such a focus on these things from day to day. And one thing I've learned, whether I like it or not, or investors like it or not, the market is very sensitive to data. Is it suggesting the economy is slowing? Is it slowing a lot? Or is the growth slowing just a bit? I think we're in this mid-cycle, I would call it. It's not like we're just starting to grow, but I don't think we're falling off like we're at the end of the cycle. That's why I don't think we're going into a recession. And I think the Fed has done an incredible job in managing, the interest rate picture. And Powell has let it be known, and the other Fed governors, that rate cuts are coming. I think the bet is 50 basis points on September 18th or 25. The market is certainly discounting rate cuts coming, but what we don't know is how much weaker the economy is going to get. I just don't see it. I don't see a Dow hitting an all-time high a week ago and then selling off a lot. S&P close to an all-time high and selling off a lot. Markets don't go down big percentages historically after hitting all-time highs, and the NASDAQ also hit an all-time high earlier in the year. So I just don't see the weakness that some are talking about. But from one day to the next, the volatility, to your point, is there, and that's why the VIX is higher. And we'll see. The other thing I would say is international markets, if rates do come down, the dollar will weaken, and you could finally start to see the European, Asian markets catch up, and the emerging markets as well. We're starting to see that, and we're also starting to see small cap stocks, which we don't talk about a lot, perform better as they have in most recent quarter, finally catching up to the big. And the last thing I would say is the growth, which has beaten value handily again this year. I'd probably lean on looking at the value a little bit. Interest rate sensitive stocks like utilities, real estate, and maybe some of the industrials and the financials are doing better as rates come down.
On the air live with Jim Hausberg, and we see bond yields coming down. Would you be making any adjustments? Is it still 60-40 for you, Jim, stocks and bonds?
Well, every account's a little different, Frank. We even have some 40-60s. But I would say this to investors in the bonds. People are very attracted to buying the short-term treasuries, Frank, at that 5.25 rate, 4.75, going out 3 months, 6 months, feeling it's safe, and then I'll reinvest. But if you reinvest in a Fed cuts 3 or 4 times in the next year, you're going to start seeing those in the low 3s. And if that happens, you're going to wish you went out a little longer. So I would tell investors to buy longer duration, fixed income, 3-5 years intermediate, 5 to 10, whether it's tax exempt or taxable. I think you get a bigger bang for your buck, and you'll plan on holding on for a little longer period of time. But the short-term treasuries are a tease to me because the rate's high. But if the Fed cuts, that rate's coming way down.
All right. Did anybody ask you about U.S. Steel today? When was the last time somebody mentioned U.S. Steel?
Frank, I just read about it before I got on. So obviously Biden thinks there's a national security issue by selling to the Japanese. I don't know enough about that, but who knows? It's above my understanding. But I think U.S. Steel, one of the great U.S. companies in history, going way back, built America,
Yep.
being bought by the Japanese, probably bothers some folks.
All right. What about oil suddenly below $70 a barrel here, despite the upheaval in the Middle East? Oil at 69 and change here I'm looking at right now. Would you be doing anything in the oil patch here?
Well, I wouldn't have bet that oil would be this low after what's going on in the Middle East. I don't think anybody would have made that call. So either there's an oversupply, which we've talked about in the past. Not a huge fan of the oil stocks, but in general, they pay big dividends. Sometimes they have to borrow money to pay those dividends. But if you want to get a yield, it's not a bad play. Warren Buffett owns a lot of Occidental Petroleum, which is hitting new lows. I don't know if he still has the position. But by the way, that stock's up 33% year to date, Frank. I don't know where it did today, but you never would have thought in a growth market, which has been the place to be, that Berkshire would be up as much as it is, but they've obviously made some big hits. Apple's been one of them, and obviously many others. So oil, not a great long-term play to me, and it's certainly not moving up on the troubles in the Middle East, which I would have certainly bet it would have.
I see Oxy down 77 cents today at 54 and change, or formerly headquartered in Westwood under Dr. Armand Hammer, of course, and moved out to Texas now, but certainly one of Berkshire Hathaway's big holdings. And Berkshire Hathaway, they say now is part of the Magnificent Eight. They've added one more here now, and that's Berkshire Hathaway, which has been hitting out of the park lately, even after they unloaded Apple. At this point, Jim Hausberg, let me ask you the big question here then. Any specific places where you are putting money now and or taking it off the table?
No, we're lightening up in some of the growth just because of the moves they've made. And some of the tech, the Magnificent Seven, through some of our funds that we use. But what I like the most, even in up markets, if it may underperform, I certainly like it in down markets, are companies that year in, year out, forgetting all the economic data that we've discussed today and other times, are increasing their dividends. Companies that are continually increasing their dividends at a clip of 10 to 15, and believe it or not, 20% a year, are the safest stocks to own, because those are the ones that are doing the best. The cash flows are there, they're reinvesting in their business, and they're growing their dividends. It's not a high dividend paying idea, Frank. It's a dividend growth strategy. And Vanguard has a dividend growth strategy that's done very well. I don't have the symbol off the top of my head. But in tough times, companies that continue to grow their dividends, that's the place to be. And in good times, it may not be the hottest area, but they certainly can do well over the long term.
Terrific, Jim. Thanks for taking the call this afternoon. Microsoft?
Yeah, well,
Jim, thank you very much.
It's one that increases dividend. Yeah, sorry.
No, it's okay. No, we want to get it right here. Jim Hausberg with Hightower Advisors and the Hausberg Group in Beverly Hills. Jim, thank you very much for coming to the line, and look forward to speaking with you again very soon.
Thanks for having me, Frank.
Thanks a million, and let's get out to the freeways now. Hot this afternoon here on 790 KBC. Oh, yeah. Get into that conga line. Good afternoon. Mottek On Money continues. The stock market not quite so hot today. Very hot temperatures, though, here in Southern California. Stocks finishing mostly lower, with the S&P 500 and NASDAQ ending down for the fourth time in the past 5 trading sessions. The Dow coming in for a closing gain today of 38 points following yesterday's 626-point closing loss. It was the worst day we'd seen since August 5th. Yesterday, only a slight rebound today. The S&P 500 extending the losses down nearly 9 points, and the NASDAQ composite down another 52 points following yesterday's drop of nearly 500 points 24 hours ago. The NASDAQ composite lowest now since August 12th. Taking a look at one of the casualties of the day, Dollar Tree, the discount retailer, seeing its biggest daily sell-off in 23 years today after Dollar Tree reported second quarter earnings that fell short of analysts' expectations. Dollar Tree shares down more than $18 at 63 and change. Dollar General getting demoted as well, down nearly $3 today to 81 and change. The VIX index, the volatility index, the so-called Wall Street Fear Index, moving up 3% today. Bitcoin down about 50 now at 58,018. Ethereum down 2 at 2,454. And Doge at the moment at 10 cents. Among the winners today, Tesla shares moving up 4%. Ray of sunshine in the cable television world. AMC Networks and Charter Communications announcing they've agreed to an early renewal of their distribution agreement that will allow Charter to carry AMC Networks' portfolio of cable networks for many years to come. Looks like the news here is that the programmer streaming apps and the cable bundle will enhance the value proposition. The ad-supported version of AMC Networks' direct-to-consumer streaming service, AMC Plus, will be included at no additional cost to Charter's Spectrum TV Select customers. Also, Charter will make AMC Plus available for purchase to its millions of internet-only customers. Meanwhile, drama continues to play out elsewhere, with Walt Disney pulling ESPN and other channels from DirecTV minutes before the kickoff of that USC game over the weekend and during the U.S. Open tennis tournament. That made a lot of sports fans angry. It looks like negotiations between those two continue. Taking a look at the Magnificent One, NVIDIA down nearly $2 today at 106 and change, and C3 AI down about 17% in after-hours trading, down nearly $4 at $19.15 a share. Gold moving higher today at $4.40 at 25 and change, and silver up 28 cents at 28.62. And price of oil sliding today. Right now, trading up 7 cents at 69.27 a barrel. And now the latest news for you here on 790 KBC. Mottek On Money continues now on 790 KBC. Good afternoon. A not-so-hot day for the stock market, including the magnificent one NVIDIA. Shares sliding again today, down nearly $2 to 106 and change. C3 AI seeing revenue growth accelerate in the latest quarter, but that stock down this afternoon and extended trading down about 17%. Of course, no business show or conference would be complete without mentioning AI these days. Let's talk AI now, IT and cutting-edge technology with Dr. Nicole Turner-Lee, who's with me now, Senior Director of the Center for Technology Innovation at the Brookings Institution, founder of AI Equity Labs, and author of the book Digitally Invisible, How the Internet is Creating the New Underclass. You just delivered the closing keynote conversation with yours truly at the HMG Strategy Southern California CIO Executive Leadership Summit in partnership with Southern California SIM, and we thank the conference chair, Thomas Phelps, for making that possible today. Dr. Lee, wonderful to be with you here. Thank you so much for the conversation we just had on the stage, where AI, of course, was discussed extensively, and talk about an AI bubble here based on the latest news that I mentioned. Give us your impressions of how AI has evolved here.
Well, I think what we're hearing, and Frank, it was so great to be in conversation with you. I think that conversation was so robust. I mean, AI is definitely something that has been on the tips of the tongue of everybody who talks about technology nowadays. AI is sort of changing the way in which we work, changing the way that we trade, changing the way in which we actually think about the weather, right? And it's that experience that people are having with AI right now that I think is both exciting businesses, but at the same time worrying consumers, particularly people like myself who sit in Washington, D.C. We've got to figure out how we actually do artificial intelligence technologies in ways that make sense to advance innovation while at the same time doing it smartly so we don't lose any money or reputational risk along the way.
A lot of enthusiasm, at least early on, that AI was going to replace humans and save businesses money. We're going to be getting the new jobs report here on Friday. What about the impact that you see playing out, the use of AI? We've had conversations here on this program about virtual employees, artificial employees. What do you see ahead on that front?
Well, I think it's an interesting concept, right? We've always had this conversation of employee displacement when it came to technology. If you can go back, when certain industries were appended because of technological disruption, people lost jobs. But I think what we're seeing differently in AI is that we're not necessarily just replacing people, but we're replacing them with robots or other virtual technologies that can actually substitute for a physical body sitting in the office. Now, to what extent that works? There are so many professions right now that are short with regards to real people, whether it's in education or healthcare. We're finding out, or manufacturing for that matter, right, in warehouses, that robotics actually can fill some of those gaps. But I think you're on it, right? These things also can't talk to you in empathetic ways. They don't have feelings. Sometimes they're not as robust as I am right now coming off of our keynote, where they can actually help express, I think, some of the human emotions that comes in our workplaces, places of exchange, places of creativity, etc. And here in California, we definitely know that AI is getting pushback when it comes to replacing the creative industry. No one wants to see creators replaced by a machine.
And the impact this is having on kids, also an important conversation. Nowadays, you don't know if you're talking to a human being or not. You could be talking to a machine, and especially important for children. What about that aspect, and what do you see? Is any regulation on the horizon, since you have a front row seat there in the nation's capital?
Well, I think people are getting concerned because technology is not the way it was originally designed, where it had some value in terms of guardrails, where you knew that you weren't necessarily talking to somebody on the other side of the internet that you didn't know. Today, because we have social media and we have so many other tools that are disaggregated, and honestly, the internet is global, it is one of those concerns whether or not kids are going to be safe when they are online. Partly because their information is being widely used to create more products and services targeted to them. Secondly, because parents don't know what's going on behind closed doors. And so I think children are becoming a huge market for the use of technology. I'm not going to suggest, because I have children myself, that it's always a bad thing, because technology has been very helpful during the pandemic. A lot of young people, Frank, went online to find friends and solace at a time when, their whole world was being disrupted, my children included. I think it goes back to having safeguards around children's privacy, ensuring that we have some type of AI literacy among parents, and most importantly, you know what? I think they need to bring back media literacy. When I was in school, I had to learn how to use a typewriter, and I had to learn how to drive a car before I got behind the wheel. We need maybe something like that when it comes to AI.
ASDF space, MLKJ space. I can hear the typewriting teacher say those letters as we had to type them out. Absolutely. I'm on the air live here with the giant on the tech scene, Dr. Nicole Turner-Lee, Senior Director of the Center for Technology Innovation at the Brookings Institution. And her latest book, which just came out, by the way, is Digitally Invisible: How the Internet is Creating the New Underclass. You had a tremendous passion on the stage here at this conference talking about the new book, Digitally Invisible. You did a great job describing how you've been watching things evolve since the dawn of the Internet. Tell us about the book.
Well, the book is really my way of giving commentary to what we have seen happen over the course of decades. I mean, I date myself back to President Clinton, a 386 computer and a modem that screeched, "You got mail," every time you got on. And you look at today, we don't have anything like that. We actually have more advanced communications. With that being the case, the book really centers the fact that even though we think everybody is connected, there are many digitally invisible people. They live in spaces where there are more cows than people, right? In very remote areas. They might be your neighbor in an urban area where they don't have technology access or they can't afford to keep it on. I think what the pandemic showed us is that we need to be connected in more ways than we ever thought. The internet really mattered. I mean, whether you were like me and you had one child in one room, another one in another room, and you were doing work, there were some people who couldn't do that. There were many kids, as President Biden always says, sitting on the stoops of Taco Bell. Well, I'm here to say they were sitting on the stoops before the pandemic, and they're still sitting on that same stoop. And our workers are doing the same thing. You may think that your worker is reporting in and able to do that timesheet application on their phone. They may not have a phone that has minutes. They may be sitting there in the dark. This is a really serious issue, but it's one, I think, of shared aspiration and goal, because we do have a society where technology has left the station, and we know that it can do so many incredible things to make our society much more efficient.
Certainly, cost, as everything, inflation has impacted the cost of getting online. What are you hearing from people these days when they have to make the decision whether to eat or have the internet?
Well, that's one of the sad things. Just a few months ago, we had a program called the Affordable Connectivity Program, the ACP. 20 million people had actually registered for that program. For those that don't know, this program provided a $30 discount towards any type of broadband service that you felt suited to actually apply to. And you also got a device discount where you could actually get whatever you wanted to get onto the internet. That program was eliminated. One, we ran out of money. And two, I think there wasn't the political will to continue it. That's a big mistake. Many of the people in rural communities here in California, rural parts of California, were benefiting from that program. But Frank, that tells me that we have to move into this digital age as we think about the dawn of AI with eyes wide open. This is not just a new technology phenomena. This is a phenomena that you have to ensure that before you can drive a car, that you got a car to drive with, and before you take it on the road, you got a road to drive it on, and before you get to your destination, you have some place to go. I think areas that we're seeing that are increasingly important with being connected, particularly for seniors, are healthcare, for kids' education, and for many of us, our workplaces.
Dr. Nicole Turner-Lee, Senior Director of the Center for Technology Innovation at the Brookings Institute, founder of AI Equity Labs, and author of the book that just came out, Digitally Invisible: How the Internet is Creating the New Underclass. Dr. Lee, thank you very much for joining us live here from this big HMG Strategy Southern California CIO Executive Leadership Summit in partnership with our friends at Southern California SIM here at the Hyatt in Huntington Beach. Thank you very much for joining us live this afternoon.
Thank you so much, Frank, for having me. Thank you.
Thank you very much. And right out to the freeways, feeling hot, hot, hot out there here on 790 KBC. Mottek On Money continues here on 790 KBC. Mercifully, the price of gas has come down as the price of oil has dropped below $70 a barrel today, despite the upheaval in the Middle East. Right now, regular gas in the Los Angeles area at $4.61 a gallon, according to the latest AAA fuel gauge survey, about 80 cents below where it was a year ago. And it looks like premium now averaging $4.98 a gallon, and that also is about 80 cents below where it was a year ago. The real cost of driving long distances these days is high. It's not just the price of gas, but your annual mileage, which plays an even bigger role in how much you spend on gas. So says Alex Gailey, who writes about consumer finance and economic trends at Bankrate.com. And Alex Gailey joined us live here this afternoon. Alex, thanks for taking the call today.
Thank you for having me here.
We drive a lot here in Southern California, and tell us about your article caught our attention here about how annual mileage really racks up the bill here.
Yeah, I think there's always a lot of attention around the prices at the pump, but annual mileage is part of an equation, is part of the equation that's often overlooked. The reality is this might sound obvious, but gas prices only matter to the extent that you're driving. Of course, driving long distances is common in the United States, and Americans' driving habits are back to pre-pandemic levels. But when we analyzed AAA and Federal Highway Administration data, we found that Americans spend more on gas on average in more affordable states such as Indiana, Wyoming, and Missouri than in states with higher gas prices like California and Washington. And that really comes down to the fact that drivers in those low-cost states tend to spend a lot more time on the road. They average nearly double the amount of miles annually than many of these other states like California and Washington.
Very interesting. So how do we stack up here in California? According to your calculations, other states, the drivers there, because they're driving so much, end up paying more?
That's right. I mean, drivers in California on average drive a little over 11,000 miles annually. And if you do the calculations, which we did, you find out that they spend about $2,000 annually on gas. This is an average figure. Of course, it depends on your car and really how much you're driving on an annual basis. But that kind of gives you a rough idea of if you're above or below that average, whereas drivers in Indiana, for example, are driving nearly 21,000 miles per year, and they shell out nearly, on average, $3,000 on gas annually. And this is considering just regular gas per gallon. And again, these costs can really vary across the country. So like I said, states that are considered more affordable, Indiana, Wyoming, Missouri, Georgia, Mississippi, they actually have, this is where drivers typically spend the most on gas. Again, these are also states where maybe there isn't as much public transportation as available. And then states where there maybe is more public transportation, other ways to get around, such as D.C., or states that are generally just smaller, Rhode Island, New York, and New Jersey, they actually spend less on gas annually, although we do see pretty high gas prices in those states.
All right. I think you're trying to help us feel a little bit better here in California with this report. So it's something that we don't ordinarily think about, but certainly very, very interesting. Gas prices obviously still very high compared to the rest of the country. In fact, I believe we're still paying here higher in California than they're paying in Hawaii, which is in the middle of the Pacific Ocean, largely because of our taxes here. $4.61 out of the average price for regular, $4.98 the average price for premium. Almost about 80 cents below where it was a year ago. So that's another ray of sunshine for us. But given the way inflation has run, people are looking to save every nickel these days. You've also taken a look at some hacks into helping to minimize gas expenses. Maybe you can share some of that with us, too.
Of course. I mean, whether you live in a high or low cost gas state, our analysis at Bankrate does suggest that there are ways to cut back either way. So, shopping around, try not to turn to the first gas station you see. If you do that, you're likely leaving money on the table. Be proactive, do some research. There are plenty of free gas apps, Gas Buddy, Gas Guru, AAA. These apps tell you where the lowest gas prices are, no matter where you are in the country. If there is a place that you're particularly loyal to, consider joining a rewards program. It might only be a few cents that you save every time you fill up, but these can really add up over time. And you could also double dip and you could earn rewards from that program. But if you also have a cashback credit card that you can use responsibly, you could also earn cashback or rewards that way. So you could earn double the amount of rewards when you're filling up at the pump. And lastly, this is the most obvious way most straightforward way to save at the pump is really to try to take advantage of public transportation if that is available to you. But if not, try to bundle your errands together so that you can save on fuel if you do need to drive.
All right. And paying with cash, right? Sometimes that saves a few pennies as well.
It does. So, yeah, it's kind of the opposite of the cashback credit card advice. I mean, you could leverage a cashback credit card, but maybe if you do tend to carry cash on hand, some gas stations do offer lower gas prices if you pay with cash. Again, small difference, maybe only 5 to 10 cents, but this can build up to some tangible savings if you're consistently doing that.
All right, and since you've had the time to take a look at all these programs, the various rewards programs that you mentioned, are there some better than others? Have you had a chance to compare them?
I haven't had a chance to compare them myself, but there are tons of reward programs out there, many for grocery stores in particular, popular gas stations like Exxon and Shell. I would just do research based on what grocery stores and what gas stations are near you and convenient to you, and sort of weigh out those options and see what you think will allow you to earn the most rewards and get some cash back from filling up at the pump.
As long as you don't have to drive too far to get there, right? So that was an important point,
Yeah.
Alex. Thank you very much for sharing the latest report with us here. Alex Gailey, who writes about consumer finance and economic trends at Bankrate.com, our friends there. Alex, thank you very much for joining us live here this afternoon.
Thank you for having me.
This is Mottek On Money on 790 KBC, recapping the day on Wall Street. After yesterday's washout, stocks ended mostly lower today, with the S&P 500 and the NASDAQ ending lower for the fourth time in the past 5 trading sessions. The Dow managed a closing gain of 38. The S&P 500 ended down by 9 points, and the NASDAQ down 52 points. Stay tuned now for the 790 KBC News Blitz with Randy Wang, and I'll be back with more Mottek on Money, more at 4 tomorrow afternoon, right here on 790 KBC.
The Rolling Stone Music Now podcast gets inside the biggest stories with Rolling Stone senior writer Brian Hyatt, movie director James Mangold.
I want to turn Bob Dylan into a simple character with a simple thing to unlock that then makes you go, oh, now I get him. First time I sat down with him, he said, what's this movie about, Jim? It's about a guy who's choking to death in Minnesota and reinvents himself in a brand new place, becomes phenomenally successful, starts to choke to death again, and runs away. And he smiled. He was like, I like that.
Rolling Stone Music Now, wherever you listen.